was this, okay? And don't worry too much about the details. You're not going to just get it after me explaining for 5 minutes. This is obviously something that takes time. I've been looking at it consistently every single meeting. You'll get used to it. It's actually not that difficult. What happened is the committee, right? They take a vote at the meeting, and the vote is where. So the question is, where do you think interest rates will be at the end of the year? Now, this matters because if you ask someone off the street, where do you think interest rates will be at the end of the year? Who cares, right? Who gives a monkey, if you don't, pardon my language, but who gives a monkey is what they say because it's irrelevant. But if someone on the FOMC committee who is voting to change interest rates every month or two tells you this is where I think it's going to be, then that obviously matters, right? So the vote was 12-7 that it's actually going to go up one more time to 5.75%. Okay. Not only that, but next year in 2024, they think it's going to stay at 5.25 the entire year. And that shocked the market because the markets previously thought, and you can see what the market prediction is here, that it would come down considerably more than that to around 4.5, 4.75. Okay. So instead of a full, and I know I'm throwing numbers at you here, don't worry. Okay. I'm not trying to bamboozle you with numbers. I'm going to try and get past the little details quickly, but details matter. All right. So just bear with me. Instead of a full 1% interest rate cut next year, which was the expectation before from the market, and also not that the Fed had committed to it, but there were at least some members who were there or thereabouts. That has suddenly changed now at the last meeting. So do you see, it wasn't about that meeting on the September 20th. The rate stayed the same, 5.5. It was about what do they suggest going forward? Okay, so the Fed is now saying, well, actually, we got one more hike to come. So obviously the market's shocked by that. And then secondly, you can almost see it here. I believe this is where the previous projections, from the Fed were. Can you see September projection? It's jumped up. Okay, so the Fed has really pushed that up, and that's a problem, right? That is a problem. Why is that a problem? Right. So now what we're going to do, right? So it's all good reading stuff, and you could have probably read Bloomberg, and they would have told you that the Fed has suggested that they're going to be higher there's going to be higher rates for longer. But how does that actually matter? Why does that matter? Right. And it matters because it's affected markets. How? Because it's basically in the bond markets. Okay. And you don't necessarily need to follow the treasury market too closely, but it kind of, things come and go. Right. And that's why trading is so difficult. I know everyone is looking for that one kind of solution that just tells them how the market's going to react forever, and it doesn't exist. Okay, things will come and go that affect the market, and right now treasury markets, the bond market, is having a massive impact. And one of the reasons for that is because we just talked about interest rates, right? And you can, but people don't really trade the Fed funds rate. There's a futures market, but it's not really traded in any significant volume, right? So whereas bond markets are traded heavily, okay? So obviously this is something that's going to impact markets much more. The thing is, it doesn't matter that it's bond market or whether it's the interest rate market, as in the Fed funds rate that we just talked about, 4.5%. The point is it's an interest rate. That's all that matters. And the bond market has gone to 16-year highs, okay? And this last leg has caught everyone by surprise. And that's been directly driven by all the things we just talked about. So the bond market is basically believing the Fed right now. And the equity market before wasn't, right? The equity market kind of was like, we don't believe that rates are going to go much higher. And the bond market has said, well, we do. Okay. And that's why we've seen this rally to 16-year highs. And that's a problem. Why is that a problem? And we are going to get onto a trade, don't worry, and you'll see how all this kind of plays out. That is a problem because the bond market has spilled over into all other markets. Okay. So I know there'll be a lot of people, and I find it quite not funny. I guess funny is not a nice thing to say, but I do find it a little bit absurd. I think that, people will say, well, I don't trade equity, so who cares? Well, actually it does matter, because you can see here FX, crude oil, and I haven't put Bitcoin and crypto on here, but it's the same thing really. You can see all the markets have been drifting down. So this red one is crude oil, that's pound yen, and this is the equity market. Okay, so all assets, commodities, FX, equities. And what's the bond market been doing? Going up. Okay, direct correlation. And this is actually from a research report at a bank. Okay, so you can see it's not only me. I haven't gone crazy. There are big banks looking at this stuff. So you can see I've literally taken this off a research report. Rising treasury yields pressure the S&P 500. Okay, so you can see the treasury yield going up and the S&P going down. Okay, the thing with me is, and I think, and I want to try and instill this in all of you, and that's why I do this, right? Because I want people to be able to trade properly, and hopefully you're doing that with the order flow anyway, rather than, doing some of the silly stuff I see people doing before that. But the point is this: I don't just take, this and say, okay, that's good enough. Obviously, I want to do it for myself as well. So can you see I've actually plotted it myself? I've taken this from stockcharts.com. Okay, I've got like a free subscription there. It's free, and I just downloaded it. But I actually did the work of typing in all the symbols. I produced it all myself, because I'm not just going to take something out of research report. I want to make sure that it does actually, the guy could have made a mistake here. Unlikely, but he may have. So I like to do it myself. So anyway, I've done it. Plus, I've added a couple more things in FX and commodities. Okay, so you can see negative correlation. Rates have gone up, the other one's gone down. Okay, so it's there. It's in black and white. Cannot be denied that interest rates are having a massive impact. All right. So in terms of the known versus unknown, so the title today being unknown. So now you can see why coming into this quarter, things have been very, very tricky. Okay. Do you see in Q2, it was known that interest rates are going up and they're going to end at some point. The peak is coming. It's in sight. So the market was getting very excited. Yes, fist pumping. Interest rates are coming to a close. Let's buy equities. And it just kept going up. Then the reality has now dawned. Oh, where are they going to end? Now the details matter. The details matter. Is it 5.25? Is it 5.5? Is it 5.75 like the Fed? You see, back here, the details didn't matter, because we were just in this euphoria that we're going to end. So yeah, great, we're going to end. Now the details matter. Okay, so do you see we're at the business end of things? And that's why the market's becoming a little bit tricky now. Very, very tricky, because there's all these unknowns. Okay, so what I'm going to do now, we're going to get into a trade. Like I said, I wanted to do a quick analysis, and so that was quite quick. We've come to the conclusion that the market is quite unsettled right now, right? So this event, the Fed event, has driven the market down because, like I said, interest rates expectations have gone up more than anticipated. That's driven equities down, as you saw, right? So you saw that. So you saw that here. Let's just remind you, interest rates gone up, equities have gone down. Okay. So how is that kind of reflected in the trading? And that's what I want to discuss now. Okay. So one of the things, right, that I had noticed over the last few weeks. So the sentiment is bearish, right? Very bearish. The market's coming down. The thing is, it's nice to have a bearish view, but has the market been moving enough to actually be able to make money out of it? So one of the things I've noticed in recent sort of times, as in just over the last few weeks, is the number of days with 1% down moves has shot up. It kind of makes sense because we've been having a down market. On average, around 30 days a year out of 250 trading days have down days more than 1%. It's important because obviously if you're going to sell, you want the market to move, right? And if it's not moving, then you're not going to make money. So it was somewhere down here, I would say, a few weeks ago. It's now shot up So what that suggests is that there is some juice in the market. You know, if you're going to get short and you have this bearish view,